Yeah. Let's so for those listeners out there who might be less familiar with, okay, what are these guys talking about tax planning? Um, there's a general statement out there which I think is not entirely true, but you hear your CPA or tax preparer, they're just focused on this year, which I think some of them are, but some of them, I'd like to give them the benefit of the doubt that some of them are looking forward thinking, but tax planning is a lot of that forward thinking um kind of mentality. And it's the concept of how I see it, and I'd love to hear your thoughts, is paying the lowest tax bill across your lifetime rather than year by year. Even though in some years you might pay a lot of tax, right? It's not to like, unfortunately, there might be years where you just take a massive tax bill, but if there's a reason for it and forethought, maybe that benefits you down the road, right?
I think that's right, Jason. You want to think about what are the ways we can increase our chances. By the way, this is all planning, so it is all subjective.
Hmm.
And we don't 100% know the future. Now, Cody and I make an argument that we actually know a lot more about the future than you might think. But that said, there's no 100% guarantees. So, what you're looking to do is maximize the chances that you will lower your total lifetime tax liability regardless of future outcomes. That's basically all we're doing here. Now, we believe there's a lot of good tactics in play at all phases of our life. Now, yes, if we're 90, there's not as much, but even there's some
Right.
tax tactics at play. But, especially for the reader that we're aiming for, I'll give you one example. We're talking about, it's called tax planning to and through early retirement. We defined early retirement as before Medicare enrollment, which is the
Hmm.
first of the month you turn 65. Well, if you do some math, today's early retiree, the oldest early retiree at this moment in time is 65 years old.
Hmm.
They were born in 1960. That gives them a good advantage. Everyone born in 1960 and later doesn't have to take the first required minimum distribution. They call it an RMD until age 75.
Right.
That's a very good advantage that those of us born in 1960 and later have. And that's just one thing that's changed in the recent years. And so part of the reason we wrote the book was because the landscape has changed a little bit. And so
Hmm.
we wanted to factor that into our analysis. And we hadn't seen a good source that had done that had folded in some of these actually pretty big changes in the last few years, and including the changes in the one big beautiful bill. So
Right.
it was time to strike while the iron's hot. But you're absolutely right, Jason. It's not about can I zero out my tax return this
Mhm.
year? Can I find all these deductions and
Right.
this one time big deduction and great, look at me, I saved on all these taxes. Well, okay, fine, that might be valuable. I'm not here to say that that's necessarily the wrong answer, but it's really about how can I play my cards so that over the course of my life, my working years, my early retirement, my later retirement, I maximize the possibility of limiting my total lifetime tax.
Sure. And I think sometimes for those, right, we're all talented and we're all smart at different things, right? You put somebody like you start talking chemistry to me, I'm not going to be, equipped for it. And I think for a lot of people who aren't really in this space, you might hear tax planning and think there's got to be all these tricks that these kind of hide and slide tricks that people are doing to lower their tax bills. And I just think in general it's not that way. And actually, it can be very complicated, and certain cases do take a special skill set, highly analytical kind of look at things. But I think generally most people can do a lot of tax planning on their own through some understanding through your book, like you have here. It's not necessarily reserved for tax experts, and I think just maybe you can't do the final, 0.2% of optimization, but you might be able to get yourself a lot of the way there, right?
I think that's right, Jason. No one needs to be a tax expert, and you certainly don't need to be an expert in the Internal Revenue Code. And I wouldn't hold myself out as an expert in the Internal Revenue Code because it's so massive and so huge. But there's all, and one of the underlying themes of our book is simplicity tends to work from a tax perspective. So I'll give you just a quick example. We live today in a low yield world. So that's a fancy way of saying if you own $1 million of a index fund that has U.S. equities, say broad based, the dividend yield on that thing in today's environment, and I haven't checked the most recent numbers, could be 1.2, 1.3%.
Mm-hmm.
So that means that $1 million holding generates 12,000, 13,000 of income. Boy, that's a pretty good way to structure one's affairs. I'm not giving investment advice in this podcast, but it is an interesting way of structuring one's affairs when we're thinking about what should we hold, especially in a taxable account. And by the way, 90% of that's probably going to be qualified dividends. So it's going to have an even lower tax rate or potentially a 0% tax rate in retirement, depends on your circumstances. But that's a simple way of arranging one's affairs that it turns out tends to be very beneficial from a tax perspective. So I think simplicity tends to win out versus all these bells and whistles. And I think the more bells and whistles you have to think about is like, well, okay, we're increasing friction, maybe expenses, and we may be hurting ourselves when it comes to tax planning.
Mm-hmm. Yeah, great points there. I had Andy Panko, who I'm sure I think you've talked to him before. I've had him on, and I like the way we kind of talked about it in that tax planning shouldn't be the main focal point of retirement planning, right? It's the optimization, and you often hear the saying, which I'm sure you've heard hundreds of times: "Don't let the tax tail wag the dog," right? And so on the other end, right, there's those who are unfamiliar with tax planning, and then you do have this cohort out there who are just tax planning optimizers who are just trying to dial it in. And I would say, there can be a downside to going too far to the other side of the spectrum. But that's like what we come back to, like you said, the simplicity, right? I mean, you don't want to take this thing and run with it to where you're running yourself crazy trying to dial these things in.
I think that's right, Jason. I think so. One thing I've noticed just sort of in my travels in the personal finance space is sometimes the availability of a tactic is substituted for the desirability of a tactic. So people read about the latest and greatest, whatever it might be, right? Bitcoin, annuities, IUL, like just name your like shiny object of the day. And look, I'm not here to say any of our listeners should or should not be in those, but let's not confuse availability for desirability. I think we have to step back and say, well, wait a minute. Yes, this may be available, but am I already on a good financial plan? And are there simpler, lower cost ways of doing things? And I think a great objective in our personal financial lives is just limiting friction and thinking about another thing you could think about is next generation. And I'm not even talking about tax planning for the next generation. I'm just talking about when the next generation inherits, these assets, how easy is it going to be for them to manage those assets and to get those assets after my death? And the harder it's going to be, or maybe that asset goes away because of its terms and conditions at your death, the harder or more likely it is that thing goes away or is harder to access, the less likely it is to be desirable for you. It's a great substitute indicator. Like, oh, if this is going to be rough on my heirs, maybe this isn't the best thing for me. You got to do your own analysis, but I'm a big fan of not confusing availability for desirability.
The opinions and statements presented on this show are for general information only and are not intended to provide specific advice or recommendations. Never make any investment or financial decisions based on information offered on this show without first consulting your financial, legal, or tax advisor. All economic and performance information mentioned on the show is historical in nature and is not indicative of any future results. All indices mentioned on this show are unmanaged and cannot be invested in directly. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Lastly, all opinions expressed by Jason Cutitta and any guests on the show are solely their own opinions and do not reflect the opinions of or are endorsed by ToBA Financial. For Jason Cutitta, investment advisory services are offered through ToBA Financial LLC, a registered investment advisor offering advisory services in the state of Hawaii and in other jurisdictions where exempt from registration.